Hi guys, it's Max. As promised, this video will be looking at sort of the big picture Elliott count. It's pretty much for educational purposes and just to kind of get into the Elliott debate on the big picture and what is going to happen, almost also taking into account the inflation deflation arguments with a bit of commentary from myself. Really, I should say before I get into this that I don't have 100% confidence in the ability of Elliott wave theory to predict trends for several decades in advance. I'm pretty new to market analysis through Elliott wave theory. I've only been doing it for about 2 years, so I haven't got the experience, let's say, or the economic or financial knowledge at this point in time to really validate or kind of really give you very solid arguments behind the theory and the implications for future financial markets. For action on future financial markets. However, I thought I'd have a go at it anyway, just to give you a few ideas, and also for entertainment purposes mainly, to look into it and contrast it with the views of Bob Prechter and Elliott Wave International. I should say straight away that I do not agree with Elliott Wave International and Bob Prechter's sort of not count, but kind of outlook at the moment, and I'm going to try and show you an alternative, and also use some Elliott Wave arguments to suggest or to tell you why I think that is perhaps an unlikely conclusion that Mr. Prechter is making. Straight off the bat, you can see the chart in front of me is the Dow Jones Industrial Average on a logarithmic scale going back from 2009, just off the March lows, to I think the beginning of the 1900s, if I'm not mistaken, all the way back. What I should say is that on my chart, I only have the I was only able to find the closing prices. Some of the people will have the highs and lows as well. If you know where I can get that kind of data on a CSV file, please send me a message. I'll be very happy to get that data and redo the video using that. As a result, these channels that I have put up may be slightly different to other people's, but nonetheless, they're just an idea of what the market is meant to be showing us. So moving straight in, I want to first say that Bob Prechter and Elliott Wave International, and also I believe Aaron Elliott himself, had the idea that the crash between 1929 and 1932 was a move of supercycle degree from a supercycle degree wave 3, circled here, to a supercycle degree wave 4. As a result, Bob Prechter is taking on this idea and believes that we have seen a supercycle degree wave 5, and this is why he is so bearish longer term. This is why he is pretty much one of the only deflation kind of the advocates of long-term massive deflation out there. Most people are sort of tend to be leaning into the inflation camp. Mark Faber, Jim Rogers, Peter Schiff, Ron Paul, a lot of the Austrian school economists are very firmly in the inflation camp, but Bob Prechter, because of this Elliott view, is pretty much the main, I'd say, financial commentator calling for massive deflation. Something I'd like to comment quickly on this is that prior to the supercycle degree wave 3, as he has it, the markets weren't very sort of not liquid, but I want to say that, you know, where he labels supercycle degree wave 1 and 2 lands in the 1700s and 1800s. Now already I'm quite sort of skeptical of this, because at the time, to what extent can you measure crowd kind of psychology, which is, after all, the point of Elliott wave theory, when the crowd was not as big as it is these days, or in terms of percentage of population? It was only really building up to the 1930s. And that period of privatization, for example, in the UK around the 1980s, where the public were actually getting involved in the stock market. So prior to that, there wasn't really too much of a crowd comparing to the 20th century. So I think, to that extent, the 20th century is far better point to kind of start looking at supercycle degree tendencies, rather than all the way back to the beginning of the stock market, as Bob is doing. Nonetheless, I'm going to show you my sort of alternative way of looking at this count, and that is in the following way. And you can see the differences here, that the red count, supercycle degrees, I believe, probably it may have been a wave 1 up to 1929 high, and a wave 2 here, and a wave 3, and a wave 4. Now what I want to quickly comment is the reason I think this looks quite nice is that taking into account the Elliot suggestion or guideline of altering counts, I want to bring you to the action scene between 1966 and 74. So if I zoom in here, if I manage to get the hang of it, you can see that we have a very nice sideways bear market lasting just under about 10 years, which turned out to be a very nice Elliot explained diagonal, an expanding diagonal. My personal view is that we're going to see something very similar to this shorter term. Now what else is gonna, well, not shorter term, in the years to come rather, but what else I think works quite well about this idea is that if you look at the supercycle degree wave 2, as I'm arguing it, it's very much so a sharp a very sharp decline. Thus, if we have a sideways bear market as we saw from the 60s to the 70s, in contrast to the sharp decline of the 30s, this will look very good for the alteration suggestion that Elliot himself put forward in his works. The second thing I want to say, which makes me not believe Bob Prechter's count very much here, is that he is suggesting that we have, if I just label it quickly for you, that we have had some sort of wave, I think in this degree, wave A and wave B, and then he is going on to say that we have had a wave 1 of C, and we are looking at a wave 2 of C with the recent triple zigzag, suggesting a 3, 4, and then a 5, all the way down to, I think his target is 2000, but you know, usually with Elliot you look at previous wave 4s, which was around 561. This is why he is so bearish on the market, and why he is calling for mega deflation to come. So bear his count in mind. The low in 2002 was an A, the high in 2007 was a B. My personal view is that this is more likely to be as an expanding sort of pattern, that this was some sort of A in 2002, a B in 2007, a C in 2009, and we are looking for another D and an E. Now I'll explain these in a second, but I hope if you memorize what these patterns that I'm putting out for you, I'll go into smaller time frames, or rather daily charts, shorter term, and explain to you the two contrasting views. So just to quickly bring you to a daily chart, which I have here, this is my outlook on the Dow. Now I have a slightly, I've got a bit of a theory with the start of this decline from sort of July 17th, or the peak in October 2007. I'm sort of experimenting and exploring this area here, but what I don't believe is, I do not think this is a clear 5-wave decline, which is definitely required to make Bob Prechter's wave 1 of C. And the reason I don't think that, and I'm going to show you this in a minute, is I think it is far more likely to be an ABC, because there is a pattern here that almost every other Elliotian I know doesn't seem to be acknowledging. Either they haven't seen it, or they have seen it, but it doesn't fit their count, so they're kind of ignoring it. And that pattern, if I just quickly zoom in, is an expanding diagonal. Now, this expanding diagonal, which I find very interesting, you can see here is the peak in 2007, if I zoom in, and then we have a lot of messy overlaps. Now, how does Bob Prechter get over this? Well, he kind of says that, I think, if I'm not mistaken, his view is that we have had a wave 1 down to here on the November 2007 low, a wave 2, a wave 3, and then a wave 4 with a minor, and I mean a very minor overlap, a wave 4 double top, and a truncated wave 5 on 2008. That is my understanding of what his view is. However, what I see here, which Bob or no other Elliotian that I've seen yet has spotted, is this expanding diagonal. Now it is sort of, to the untrained eye, very difficult to spot, but if you connect the low on 2002 October, November 2007, and January 2008, you can see that there is a support line at the bottom. You can even probably make this upper resistance line from the actual peak here and do something like that, but nonetheless, I think you get the idea. And the point is, this makes me think that this is indeed a wave A rather than some sort of 1. what I will show you here is, and I will expand and show you some more Fibonacci relationships between, if this is a wave A and this is a B, and this decline from May 2008 to March 2009 is a wave C, there should be a Fibonacci relationship. And I do think that this works to sort of give weight to my count over Bob Prechter's one, is that if you look at the wave A Fibonacci relationships, Fibonacci retracement lines, sorry, and I will make them in red or green to make them a bit more distinguishable. So here are the Fibonacci retracements of wave A. You move them down to the start of wave C. Oops, wrong line. You move these down to the start of wave C as such, and you can see that the decline is almost point for point to the relation between what I'm saying is a wave A and as a wave C is almost on the dot to 261.8% the distance. What else is quite interesting is prior to, if you look at where the actual Elliott pattern began, where the decline came, well, it started from the October 2007, but in terms of Elliott wave, you look at these patterns and you have to think, well, where did the decline come? And I think there may be reason to believe that the Elliott pattern actually started from July 19th, 2007, rather than from the October highs. And the reason I think that is a possibility is that if you go back to there, you can see a corrective decline, which is quite clear, which is obviously an A, B, C, but then there isn't a very obvious impulsive move to the upside. What I think we see on the other hand is rather an A B, and a 5 wave 1, 2, 3, 4, and a 5 to the end to complete an ABC. So if this is indeed the case, there is an A, B, and a C prior to what most people see as the top for this crash. Then we have an A, B, C down. I think it is far more likely that this is being an ABC rather than a 1, 2, 3, 4, 5. And in my, if you remember, in my count, this comes as a potential wave C of a larger expanding sort of sideways pattern with a wave D and E still to come. Now, the recent action since the March 2009 lows is a triple zigzag. I have had very bad success. I'll put my hands up and honestly admit that my success rate at labeling this pattern hasn't been great, and one of the reasons was because I was only learning about Elliott wave patterns as this was emerging. So I had to look back on it up until the highs in April 2010. Now, since the highs, you would expect a very clear impulsive pattern, as Bob Prechter is claiming this is a wave 1 and this is a wave 2 complete. There is a nice Fibonacci relationship between this decline and that peak, granted. If I just show it to you now, you can see that it is 61.8% on the dot and we fell away. However, I do still think that we will move higher because of the Fed's proposed monetary stimulus that it will most likely look to introduce even further if it sees the markets start to slide. Now, since this peak, we have had a decline, but by no means is this decline very clearly impulsive. Thus, if you remember from my other videos, as I'm viewing this as an A, this as a B with the recent ending diagonal and the irregular ABC, and then I am looking for one more wave C down to complete a, I'll make this blue just to keep things relatively tidy, a wave B, and then expecting another wave C to complete this red wave D. I hope this isn't becoming too complicated, but this is unfortunately how Elliott wave is sometimes presented. So as such, and then a 5 wave rally for the wave C. Like this. I have to move that over a little bit. my personal view on the fundamentals is that the Federal Reserve will pump money like there's no tomorrow, but there are not enough trees in the world to stimulate an economy through printing money. Thus, I think there'll be an inflationary stock market bubble, which as soon as inflation starts to kick in and the interest rates will be under great pressure to rise, as soon as those interest rates start to rise, the market's artificial levels will again come crashing back down for a wave V. Again, I mean, this analysis is, as I said at the beginning of this video, I don't have 100% confidence in the ability of Elliott wave to analyze markets in such long time spans. But this, I think, is probably a more likely view or explanation of the market than Bob Prechter's, because I think, I mean, to an extent, I'm skeptical of saying that the only reason we're going to have massive deflation is because the Elliott wave pattern suggests so. The reason we had massive deflation in the 1930s is because the Federal Reserve, under the gold standard system at the time, actually took measures to hold back gold coming into the country from England and France, which would have stimulated the economy through monetary means. To suggest that we are going to have the same sort of levels of deflation as seen in the 30s on a background of completely opposite monetary policy and economic almost completely opposite economic situations seems a little bit, not extreme, but I don't want to use the word unscientific, because let's admit technical analysis is more of an art than a science, but I would instinctively say that it does seem a bit ludicrous. So this is my view longer term. One thing that is of interest, and I think people should consider this when looking at this as a wave 1 of C, the Dow Jones is most closely related to the FTSE 100. Even the prices used by Bob Prechter on the longer term scale prior to the peaks of the super cycle 3 degree, before the American market existed, to find supercycle wave 1 and 2, if I'm not mistaken, he actually looks at stock prices in London, being the sort of financial capital of the times before America became such a superpower. So you'll have to accept that the relationship between the American markets and the British markets have to be assumed to be interrelated. If this is indeed the case, then it's very odd for Bob Prechter to label this as a wave B and to say that the markets topped out in 2000, because if you look at the European markets, particularly the FTSE 100 and, if I'm not mistaken, also the French CAC 40, the rally from 2002 to 2007 on those European markets is very clearly impulsive looking. So it seems odd to suggest that these two markets, which are being used to find supercycle degree counts in the 1700s and the 1800s, are now diverging according to Bob's bigger picture count. My explanation of it, my interpretation of it, would be simply that the British market topped in 2007. So likewise, just like the American one, the first leg down to 2009 was also an ABC. You will also find this expanding diagonal pattern on the FTSE 100 in the exact same place, working in the exact same way, and you will find the Fibonacci relationship of A to C at around 132.8, if I'm not mistaken. That's the Fibonacci number. And everything else looks exactly the same, but this rally looks very different on the British markets. So where the American markets have already had a Elliott wave A here and a wave B here on the American markets, the English markets have only had a wave A and are looking for a B up. But nonetheless, you can see that with both these patterns, the implication is that even if the American markets are in stages D and E and the British markets are in stages B and C, when they do get to their final stages, i.e. C and E here, they will both be complete in terms of corrective Elliott patterns. And one more thing I do want to add just quickly before I finish off this video, it's already quite long as it is, this idea of a large head and shoulders, this being a head, shoulder and another, a shoulder, head and another shoulder, I do want to say that you have to be careful with this because there is no upward sloping neckline. The neckline is downward sloping, which would suggest to me that it is far more likely that we could have our triangle scenario bounce off this low at around 5,000 something, in the high 5,000s, depending on what time it happens, and that we could have perhaps a very, here is the basically this is my general idea for the American markets. And when we get to this wave E after some sort of crash of an inflationary stock market bubble, then another sharp probably inflationary move up again. This will be on the backdrop of perhaps something similar as what happened to Mexico in the 1980s or so, where the peso was completely destroyed by the central bank, but the market did rally to extreme levels. So this seems to have this sort of relationship with historical events to suggest this kind of outcome rather than the massive deflationary crash Bob Prechter is calling for. Guys, I hope you enjoyed this video. Again, I do seriously welcome comments, and I do want to open the debate on this discussion. I'm actually going to probably post a forum topic on the network that I have created, the Trader Lounge. You will find the link at the bottom of the YouTube description box. Please feel free and come and join us there. It is 100% free. It is just a community for traders and investors to discuss market ideas, Elliott wave analysis, just general chart patterns, just have a friendly conversation. We have about coming up to 300 members now from all over the world, from the UK, from the USA. We have members in Japan, in Eastern Asia. So please feel free to come and join us there. I invite you to debate my analysis and my views on the markets, and I hope you enjoyed this as always, and I hope so with this video more obviously than the others. Nothing you see here should be taken as investment or trading advice, for the obvious reason that this sort of analysis, looking at several years in advance and 100 years in the past, is going to be very largely unscientific. So I will openly put my hands up and say I don't have 100% confidence in the turnout of this, but if in a few years from now this does happen, I think Elliott wave will probably be my definitely preferred analysis method of choice. Thank you very much. Ratings and comments, as always, are welcome.